course, we all know the purpose. The target borrower, this is the target borrower. Now, here, we, under our mechanization program, we don't allow individual farmers to own tractors. It is just outside of. We have broken the borrowers into 3 groups. We have the risk-free 1, 2, and 3. Here you have entrepreneurs and individuals that says, look, I have the equity, I can behave according to the terms of this guideline, I can meet the requirements of TOAN and TOFAN, I can meet the requirements of the banks, and I want to do mechanization as a business. So we recognize that kind of individual as entrepreneur to participate. It's important for the banks to take care of that. It doesn't have to be a farmer that goes to the field. We also recognize farmers themselves coming as groups, not individual farmers. A group of farmers doing maize or soybean or whatever can come together and apply under the framework. But of course, the obligors will be the individuals within the group. And then finally, you have agribusiness cooperatives, the standard cooperatives that we all know. So this is the group 1 of our borrowers. The group 2 is like an evolution from here to here. You would find somebody who is so successful here saying, look, I will move from being an ordinary entrepreneur to a small company, a growth company, because he would have mastered the rules of the game. So we allow evolution from here to here, and the bank and us will realize that, yeah, this guy has been successful in this group, so we can allow him to graduate to this group and give him additional support. So we recognize growth companies, but ultimately we also recognize the large corporation. Nothing stops somebody from moving from here to here to here over time. But that doesn't mean a large corporation, like I made an example of SEOA, for example, saying they want to participate, they are also recognized. And I think we can make a comment here. Should there be any other permutation or a group that is likely to come up that we didn't recognize, that can be taken care of. The lenders, banks, discount houses, asset managers, and specialized trade finance providers. This list is fully recognized in our master risk guarantee guideline, which you all have. So this is taken care of. And the channel partner here is none other than the equipment vendors. It's so specific. These are the partners that are the drivers of this. You could see there are 4 key partners here. You have the lender, which is you. You have the guarantor, which is us. You have the borrower, which is either TOAN or TOFAN members. We're very careful here. We don't want anybody outside of these 2 associations for a reason that you will see as we go along. Then finally, you have the, I said the lender, the guarantor, the borrower, and of course, the vendor, the equipment seller. So it's really a mutually benefiting and reinforcing ring-fenced system where everybody has to play according to the rules of the guideline. Anybody of those 4 that does not play according to the rules of the guideline means he's not ready to participate under this framework. He could do his ordinary business in tractor, which is unstructured, which is not determined. You know, this is his business. But if you want to come here and enjoy the benefits of NIRSAL, then these rules apply to you, which we're going to see down the line. Now, on our part, we the guarantors, let's now go. You can see we're moving from general to more specific now. Now, these are the credit terms as designed by NIRSAL in collaboration with all the stakeholders. You could see that on our part, we will the financiers now. If you look at it, we call them sweeteners because we want to sweeten it for you to lend to the borrowers to be sold by the vendors. Here we said we expect each borrower under each of those categories to put down 10% as equity, or it could go up to 20%. Now I know there could be issues here. Even though we did put a range of 10 to 20, organize them, and local governments, that they could be bona fide borrowers provided they do 2 things or 1 of 2 things. A state governor can say, look, I love this framework, I love the fact that I don't have to put my money, it's going to be commercially financed. I can organize TOAN members or TOFAN members in my state because the benefits come to my people. As long as they follow these rules, I can organize and hand them over to TOAN or TOFAN according to the rules of the NIRSAL mechanization framework. If I do that, I'm ready to support those borrowers in my state with their equity contribution. In this case, we don't want the state to be too much of a Father Christmas because commercial discipline borrowing and paying and business discipline must come in, because if you take up everything, the borrower will just be complacent and he will not follow the rules. That is why we limited to set support for its borrowers at 40%. The other stream is where a state government will say, look, in addition to the indigence of my state, I'm ready to revive my tractor hiring units. And these are scattered across all the states. In this kind of situation, still, we regard the state through its tractor hiring unit as a borrower. Don't forget, NIRSAL guarantee does not recognize state as a borrower. The tractor hiring unit in this respect has to be a full corporate entity that can sue and be sued. That means a special purpose vehicle. In that respect, the state can turn around and say, okay, look, I'm ready to convert my tractor hiring unit into a full limited liability company, and I'm ready to provide an ISPO guarantee behind my SPV to cover whatever that SPV takes. But once that is done, that SPV, as far as NIRSAL is concerned, will be regarded as a normal borrower under the mechanization framework with all the rules. So you could see virtually every possible borrower has been recognized here. Please, if you have comments, you can take note of that. Now, again, I mentioned whatever the kind of support state government or local government can give either to individuals or to its tractor hiring unit as a special purpose vehicle will have to meet the commercial and technical requirements of the NIRSAL guideline for us to accept it. And it's important for the banks too, because if it doesn't meet our guideline, even if you start that discussion, we will not be able to guarantee it. The other sweetener that is very unique innovation that we have decided to put up is the buffer fund. Now, this is the sum of the first 3 months. Since we don't have a secondary market for used tractors and organized secondary markets, we will not be able to know in the open market a Massey Ferguson, a Mahindra, or a John Deere of this age, of this quality, of this maintenance is this price. So we don't have a neutral market that will give us a signal as to what the price will be if the tractor is 6 months old, or 12 months old, or 18 months old. So that's why we created the second value option. In the absence of the secondary market data, the vendor will have to agree to use the following as a percentage of the outstanding loan, principal and interest, less any administrative handling fees. That is in the event of recovering the equipment. And don't forget, in our framework, before a tractor reaches this level of recovery or repossession, there is a long process. In fact, we don't expect a well-managed system to even reach this level for even the vendor to activate it. There are a lot of intervening steps that will make sure we don't reach this level, because once you reach this level, it means the loan has gone bad, the relationship with the customer has gone bad, and a lot of things will have to happen. But then we provided for it, where the vendor will have to agree to pay 50% of the outstanding, recover that tractor, and pay back the bank. We expect that within the first 6 months, at least a large percentage of the value of that tractor would have been paid to the account of the borrower. Now, what will trigger a buyback, which is the last stage? Due to the seasonality of the tractor business, if a borrower is not able to make 100% of the expected payment, it will not be considered an immediate trigger for a buyback for the reasons I gave. It could be circumstantial, it could be the region where he's working, the farming season has finished, it could be Towan or Tofan is trying to move the tractor to another region of the country where cultivation is still taking place. So these are things that we will see on ground. But under all circumstances, we will provide a grace period of 90 days, which is equivalent to those 3 months I mentioned earlier, behind which will be the buffer account. Within those 3 months, all stakeholders will know what is the matter, what's the matter with this borrower, what is the matter with this tractor. Whatever happens, the bank knows is holding on to the 3 months buffer amount in the account. And in the event that the beneficiary does not make payment at the expiration and the depletion of the buffer account, then a definitive default will have occurred. I hope you follow what we mean here. There are a lot of steps. We will not declare because somebody has not paid 1 or 2 months that it's a default, no, because it's circumstantial. But after that, and we give a few number of days and he has used up that money, then a definitive default will have occurred. Now, these are the steps, very technical. The unlisted should be followed by all parties in effective advisement to keep the association abreast of the payment status of members and to begin the internal process of reallocation of the equipment to another member. Once an event of default occurs, that is zero loan repayment for 3 payment cycles, the bank is mandated to inform the the association, vendor, and NIRSAL. Step 3, association will then reallocate the equipment to another interested party, which is willing to replenish the buffer account, as well as maintain the loan liability without any default. If after 15 days into the 4th month, after the 3 months the buffer is finished, the association is still unable to reallocate the equipment, then and only then the vendor buyback is effected, which will effectively transfer the possession of the tractor from the association to the vendor. These are the intervening steps. First of all, the bank should alert the association and NIRSAL that, look, so-so borrower in so-so location has not effected payment, even within the first month. It's important to start flagging that particular account, and all 3 parties should know, so that to allow the internal process of relocation. Now, if it reaches the level we get a definitive information that we feel that this borrower is not likely to make further payments, there is the first signal, then there is the second signal, and we in NIRSAL we need to know because our guarantee is at play too. Now, at that point, the association will reallocate the equipment to another interested party. Don't forget, at this point, after 3 months, the bank is well in its right to use that 3 months' money to make up for those periods that he has not paid. But even at that, we have not touched on the vendor yet. What we expect that this tractor will be repossessed by the association. Don't forget, within the association, there's always a long queue of potential borrowers that want to join. They always have that buffer of list of quality customers. Now, if a customer within the association fails and he loses his buffer account, he loses